All right, let's get right into it. Today, we're going to break down something that is, I think, at the very heart of successful long-term investing, the practical application of expected value. This is really the engine behind returns, but it's often misunderstood. So we're going to explore how you can actually apply it to your own process.
And this right here, this is the whole game. Michael Mauboussin calls this the Babe Ruth effect, and it's such a powerful idea. In investing, it's not about your batting average. It's about your slugging percentage. It's not how many times you get a hit, it's how big those hits are when you connect.
Okay, so here's the plan. We'll kick things off with that big idea, the Babe Ruth effect. Then we'll get into the nuts and bolts of expected value. After that, we'll cover what might be the most important practical concept here, the difference between arithmetic and geometric mean. Then we'll tackle the psychology of it all, and finally, see how this plays out in the real world.
All right, first up, the Babe Ruth effect. And really, this is all about a mental shift. It's about changing the goal of investing away from just being right and toward making sure your wins are massively impactful.
So let me ask you this. For a professional investor, what's the real key to beating the market over the long haul? It's not about being right 60 or 70% of the time. It's about structuring your process so that when you are right, the payoffs are so large that they more than cover all of your mistakes. A few big winners can and often must pay for the whole portfolio.
Okay, so if we want to maximize that slugging percentage, where do we even start? Well, it all begins with breaking down expected value into its two fundamental parts, payoffs and probabilities. And we're going to start with the nature of the future we're all trying to forecast.
You know, a lot of people think investing is like a casino game, right? Where you know the odds of the dice. But the reality, as the economist Frank Knight pointed out, couldn't be more different. We're not playing with a known deck of cards. We operate in a world of deep, profound uncertainty, where the distribution of what might happen is a complete unknown. And this is such a critical distinction. Think about something like human height. Most people cluster around the average. That's a mild distribution. But markets? They don't work like that at all. They follow wild distributions, where just a handful of massive winners or losers, those black swans, completely dominate the outcome. Your entire portfolio's performance might come down to just one or two incredible decisions. So that's the payoff side of things. But what about the probability side? Well, here's where we run into our biggest enemy, ourselves. Prospect theory shows us that we are just hardwired to get this stuff wrong. I mean, come on, who hasn't held on to a loser way too long, just praying it'll get back to even? That's your brain fighting the math.
So how do we fight back against these built-in biases? One of the most powerful weapons in our arsenal is using base rates. It forces you to shift your thinking from, what do I think is going to happen with this company, to historically, how have companies like this actually performed? Look at this chart. Only a tiny 6% of companies manage to grow sales over 24%. Knowing that base rate is a huge, humbling reality check before you go modeling some heroic growth forecast.
Okay, this next section. Honestly, if you take only one thing away from this whole explainer, let it be this. The profound, and I mean profound, difference between the arithmetic mean and the geometric mean. Getting this right is everything for long-term compounding. Here's the simple way to think about it. All that classic portfolio theory, Markowitz, it's basically taking a snapshot. It's optimizing for one single roll of the dice. But that's not how investing works, right? We're in it for the long haul, reinvesting our money over and over again. And that means we have to focus on maximizing the geometric mean, the rate at which our wealth actually compounds. Okay, this table makes it so clear. Let's walk through it. If you're a one-and-done gambler, opportunity C looks like a no-brainer, highest average payout. But if you have to reinvest your money, which is what we all do as investors, look what happens. Opportunity B is guaranteed ruin. Opportunity C will eventually bleed you dry. The safest bet, Opportunity A, with the lowest single bet average, is actually the one that makes you the wealthiest over time. It's completely counterintuitive, but it's pure math. So what's going on here? There's a fancy word for it, non-ergodicity. All it means is that the average result of 1,000 investors isn't the same as your personal result over 1,000 days. The market average doesn't care if you go bankrupt, but you do. You only have one path, and if that path hits zero, it is game over, period. This leads us to the Kelly criterion, which boils down to three simple but incredibly powerful rules for staying in the game. 1, if you don't have a quantifiable edge, just don't bet. Simple as that. 2, Size matters. The bigger your edge, the more you should bet. And 3, and this is the one that gets everyone, never ever overbet. It's the #1 cause of ruin, even when you're right about the investment itself. All right, so we've got the math down, we understand geometric returns. But now comes the really hard part, fighting our own brain, which is basically wired to do exactly the wrong thing. And it all starts with what Daniel Kahneman called the most significant contribution of psychology to economics, loss aversion. It's that gut-wrenching feeling you get when a stock is down. That feeling is an ancient survival instinct that is just toxic for your portfolio. Think about it. Selling a winner just to lock it in feels good, right? It feels safe. That's loss aversion, pushing you to cut your flowers and water your weeds. And this isn't just a feeling, we can actually put a number on it. The pain of losing $100 is roughly twice as intense as the pleasure of gaining $100. That is a massive asymmetry in our emotional response, and it drives so many bad decisions. And here's the kicker. This effect gets way, way worse the more frequently you check your portfolio. It's called myopic loss aversion. If you're looking at your P&L every day, you're just torturing yourself with a constant stream of small losses. You're feeling that 2x pain over and over, which makes it almost impossible not to do something stupid and short-sighted. Okay, for our final section, let's pull all of this together and look at how these different payoff profiles actually show up in the real world, across different types of stocks. So first up, let's look at your typical public stock portfolio, say the Russell 1000. The distribution of returns is, well, it's pretty tame. Most of the time, about 75% of the time, you make money. The most likely outcome is a decent but not life-changing gain. Those massive 10-baggers, they're incredibly rare. But now, look at venture capital. It is a completely different universe. This is the Babe Ruth effect on steroids. Most of your bets, over 60% of them, are going to go to zero. They will fail. The entire strategy hinges on the fact that just a tiny, tiny fraction of those bets will return 10x, 50x, or even more, and pay for all the losers.
And this table just sums it all up beautifully. Different strategies win in different ways. A diversified mutual fund is playing for a high batting average, lots of small wins. Venture capital is playing for an insane slugging ratio and accepts a terrible batting average because it knows one home run can win the entire series.
So here's the million-dollar question. If you want to play the slugging game, what's the real price of admission? It's surviving the journey. You have to remember that every single one of the greatest stocks of all time, Amazon, Apple, you name it, had terrifying, gut-wrenching drawdowns along the way. Amazon dropped over 90% at one point. To get those massive returns, you absolutely must have the stomach to sit through that kind of volatility.
And that brings us to the final question, and it's one I think you should tape to your monitor. Is your process, your day-to-day decision-making, truly designed to maximize your long-term geometric growth? Or are you getting caught up trying to maximize this quarter's average return? The answer to that question will define your entire journey as an investor.